Hello, my name is Michelle Butler, Portfolio Specialist at Cohen & Steers. As 2022 progresses, we're witnessing many markets off to a choppy start, with expectations for global growth to slow, yet inflation remains elevated. In this environment, we believe investors are appropriately turning their attention to real assets. Today, I'd like to focus on three key historical benefits of a strategic allocation to real assets. First is outperformance during inflationary periods. Second, diversification potential, meaning something that behaves differently than traditional risk assets, such as stocks and bonds. And third, attractive total returns over full market cycles. All right, so let's begin with number one, inflation beta. The factor that all real assets have in common is their potential sensitivity to inflation surprises. Inflation often affects both asset prices as well as revenues of real assets. And we see that both directly and indirectly. Directly through contractual inflation linkages, or in the case of commodities, direct inflation inputs, so think food and energy, or indirectly through fundamental economic drivers. The ability of real assets to counter inflation offers potential benefits to portfolios in the short term, should asset prices rise, and also in the long term, should inflation continue to surprise to the upside. The result of these inflation relationships has historically been strong returns in environments of rising and unexpected inflation in terms of both individual real asset categories, and what I mean by that is real estate, infrastructure, commodities, resource equities, as well as a diversified blend of real assets, combining each of those core four real asset categories that I just mentioned into a single multi-strategy portfolio. Now, in contrast, stocks and bonds tend to lag in those environments. So that's one, is inflation sensitivity. Two is diversification potential. Real assets' distinct economic sensitivities tend to really differentiate them from stocks and bonds. In this example, we highlight the beta of real assets to global equities over time. And as you can see, we showcase both the beta of the individual real asset categories and the real assets blend, which is combining each of the core four real asset classes within one multi-strategy portfolio. By definition, a beta of more than one indicates that the asset class, over the specific time frame being analyzed, exhibits more volatility than the market. And we're defining the market as global equities here, or the MSCI World Index. A beta of less than one indicates that the asset class tends to behave differently or be less volatile than the market. In this case, the low market beta of real assets suggests significant diversification potential, helping to reduce portfolio volatility and, we believe, improve risk-adjusted returns. So thus far, we've talked about inflation sensitivity. We've talked about diversification. Now let's take a look at that third key benefit of an allocation to real assets, its total return profile. Real assets have historically generated strong returns over a full market cycle. And if you look at the individual real asset categories in this chart, with the exception of commodities, all have delivered performance in line or better than global stocks over the past nearly 50 years. And again, I'm going to call out commodities because it's well worth explaining. The long-term average return of commodities was depressed post the global financial crisis by a multi-year bear market. And that was really a result of unfavorable supply-demand fundamentals. Specifically, it was a market in oversupply, right? However, the macroeconomic and, more importantly, the fundamental backdrop for commodities is significantly improved, providing what we believe to be the potential catalyst for a sustained multi-year recovery. We saw it last year, we're seeing it this year. And perhaps more importantly, commodities can help provide significant diversification potential. These are futures we're talking about, not equities, and inflation protection benefit. And that can prove highly valuable in certain regimes like the one that we're seeing today. So I've spoken to the benefits of the individual real asset categories, but look at the real assets diamond. That's a blend of real asset indices, and it illustrates the potential benefit of combining multiple real assets within a single portfolio. And the result? Competitive equity-like returns with significantly less volatility than global stocks or even standalone real asset categories. And why is that? It's because each of those core four real asset classes are different, but you put them together under one hood and you can achieve those important diversification benefits. All right, so to recap, as investors consider and think about how to mitigate the risks associated with slowing growth and elevated inflation, history has shown that including real assets in a portfolio may provide outperformance in inflationary periods increased diversification, and strong risk-adjusted returns over a full market cycle. And finally, we believe investors' approach to employing real assets within the portfolio is going to vary. It's going to depend on individual investment objectives, preferences, their current allocation structure. Many investors prefer to allocate individually to each of the real asset categories, so they'll have their portfolio of real estate, infrastructure, commodities, while others prefer to gain exposure through one multi-strategy real assets offering, essentially achieving the benefits of the blend in a single capability. The good news is you have options, and there are a variety of real asset investment solutions and vehicles available to cater to investors' needs and different risk return tolerances.